My name is Karen McCabe. Ken Bowen, our state coordinator, is also going to join in, especially in the Q&A portion. I'll do the presenting, and I'm going to leave the heavy lifting to Ken. Just a few things before we get going, a few caveats to this information I'm presenting. I'm taking the majority of this information from a presentation that was given about 10 days ago, back on December the 4th. There have been some changes. This is a fluid process as they are trying to get all the documentation. Both the IRS is working on it, TaxSlayer is working on it, the NTTC, the National Tax Training Committee, is working on it. And so instructions and revisions continue to happen day by day, and I'll do my best to bring you the most recent information. But the best thing to know is additional IRS and TaxSlayer updates are going to be communicated as we know them through the 4491 manual and the 4012 manual. I will tell you though, they haven't released an updated version yet because they're still waiting on additional explanations, and they don't want to keep sending out revision after revision. So just know, I know already, already there are things in the 4491 and 4012 addressing the changes, and just keep checking back to stay tuned. As far as checking with Delaware, and if Delaware is making any changes to their tax laws, I honestly don't know. And if anybody else does, first time we ask questions, you can certainly bring it up. So first, we're going to talk about 1040 changes, some of the more simple stuff before we get into the real reason why you're on the call. So the draft 1040 is on the IRS website already. What you're going to see is more what they call self-reporting, things that are already in TaxSlayer or on our intake forms, and they're now going to show up on the return itself. Another thing that affects us, the IRS address in Cincinnati is no longer a valid mail-in address. I think it was a mail-in for maybe estimated payments, something like that, for folks from here in Delaware. TaxSlayer has already made the change, so mailing instructions for payments in the tax year 25 will be correct and will no longer include that address. If, however, our taxpayers are sending in estimates that we printed the vouchers last tax season and they're being sent to the Cincinnati address, the IRS is forwarding to the proper IRS center. So this is a look at the draft 1040. This is the front page. There are a few boxes that are highlighted. If you're working in a combat zone, for example, if the taxpayer or the spouse is deceased, right up the top is noting the date of death. There is more information down on the dependent side. It's taking, again, some of the information that we input and just referencing, are they eligible? Are they a full-time student? Are they permanently or totally disabled? Are they eligible for the child tax credit and such? And then at the bottom, there is a checkbox if you're using married filing separate or head of household. You're just confirming that you lived apart from your spouse for the last 6 months of the year or are legally separated. In essence, as you see these changes, the IRS is basically saying, okay, we just want to know a little bit more on the face of the tax return. Page 2 will show some, or no, I'm sorry, this is still on page 1, but some additional disclosures, some same kind of questions, but they're being highlighted. And so that's a change you'll notice, and it is on page 2. Moving on, digital assets. There is, you may see a form, the 1099 DA form that's new for this year. We already know that the handling of digital assets, if there is a transaction that occurs That's out of scope for us. That hasn't changed. But what may be easier for us to determine that fact is if a taxpayer comes in and in the midst of their tax documents is one of these 1099 DA forms, and that immediately tells you, hey, sorry, unfortunately, this is out of scope for us. Moving on, the 1099-K, which is reports of credit card transactions and proceeds, the threshold had been going down the last several years, and the threshold to which payers had to report these transactions. It used to be you're getting down to like $2,500, and anything above that, any transactions above $2,500 would generate a 1099-K, or would be the need for a 1099-K. That threshold has changed and gone back to what it used to be. So it's $20,000 and 200 transactions. That is the threshold for the 2025 reporting. However, don't be surprised if you see forms that are issued at that lower threshold, even if it's not required. And it's just due to the payers having already programmed the forms for this year. There's really no reason for them to go back and make any changes. Some permanent changes affecting 2025, that the Tax Cuts and Jobs Act from 2017, the tax rates and the annual indexing, that has been made permanent. Standard deductions and the annual indexing of them also have been made permanent. The only slight change that happened as a result of the OB3 Act is that the standard deduction amounts, for example, for this year were increased. And the zero personal exemption amount is now constant and it will not expire. The good news is in all this, TaxSlayer is handling this. Rick, did you have a question? Rick Engelman?
Yeah, thank you. On the previous page with the 1099-K, do we still, I assume we still enter them into TaxSlayer regardless of whether they're above or below that new threshold. Is that correct?
Yeah, because it would be part of the Schedule C. And so, and that's where you would be reporting it. And so I would say the answer is yes.
Okay, thank you.
You're welcome. Ooh, I answered a question right, I think. That's a good sign. Okay. All right. Staying on with just some permanent changes. So the child tax credit, the additional child tax credit, and other dependent credit, the bill did increase, the 03B bill increased the tax credit from $2,000 to $2,200, and it is permanent and subject to annual indexing. In addition, the up to $1,700 for the additional child tax credit, which is a refundable credit. The child tax credit is a non-refundable credit. So the ACTC, it's too, is already indexed. Now, this is a new requirement if reporting or trying to be eligible for the child tax credit. They are requiring a Social Security number. Either if you're married filing joint, either the taxpayer or the spouse, one of them has to have a valid Social Security number. This is new, and just want to make you aware of that. The MAGI limits stayed the same. Other dependent credit stays the same at $500 per dependent, and the credit was also made permanent. Sorry. Based on TaxSlayer has already handled this in the past, and that won't change. These changes are done through the software itself. Moving on to state and local taxes, otherwise known as SALT, that the limit prior to this year was $10,000 that you could claim on state and local taxes as part of itemizing. That cap has been increased to $40,000 for the period 2025 through 2029, and it's subject to a flat 1% indexing each of the subsequent years. There is a phase out based on the income levels shown on your screen: 500,000, 250,000 married filing separate. Now, it's possible with this increase in the cap going from 10,000 to 40,000, more folks may be able to itemize. I'm not sure if that's going to impact us here in Delaware. Where you're going to see the greatest benefit, or the states that will see the greatest benefit, be like those that have high property taxes: New York, New Jersey, California, that folks are going to be able to take more of these property taxes as part of their deduction. And in 2030, this cap reverts back from 40,000 down to 10,000. As far as charitable contributions, just a couple of changes to mention: that this year, deductible charitable contributions will also include all Veterans Services organizations. I will tell you that when I was on the call that discussed these changes, somebody asked a question: well, what would be an example? Because most of the Veterans Services organization, Wounded Warriors, Purple Heart, they're already 501c3 organizations and eligible to have contributions deducted. And I'll admit on the call, they didn't give an example, but I'm just giving this information to you. Now, even though what I'm about to talk to you about is in 2026, up to $1,000 can be added to the standard deduction. And I'm sorry, this has to do with, excuse me a second, charitable contributions. If you remember, during COVID, there was, for a couple of years, people could take if they were not itemizing, they could still take a deduction up to $600 for charitable contributions, and I believe it was $1,200 married filing joint. That then went away. Well, starting in 2026, it's back, and it's now up to $1,000 of charitable contributions that will increase your deduction amount, and $2,000 married filing joint. Only reason why we're reminding you of this now is, as you're doing tax returns this year and you see a taxpayer has got charitable contributions, just remind them that, hey, starting in 2026, you will be able to take this deduction on your tax return. Just keep the receipts. Yes, Jim?
That's cash only though, right?
Yes, cash contributions only. Thank you. And this is going to be a permanent deduction, which is good to know. So when we talk about, and maybe you haven't heard the term below the line deduction, above the line deduction, many of these new deductions we're going to be talking about are what we call below the line deductions. The line we're talking about is adjusted gross income. So any adjustments to gross income are what would be called an above the line deduction. What you would take off your gross income to get to that adjusted gross income. Things such as gambling winnings, unemployment compensation, those, and they're listed primarily on Schedule 1 of the return. Those are what we would call above the line deductions, because it's taking your gross income from wages, Social Security, pensions, and any other income to come up with that adjusted gross income. So that's above the line. Below the line would be your standard deduction or itemized deductions. And up until this year, it was just qualified business income. Now, We have 4 more below the line deductions, and this is why you're all here this morning, to hear all about them and what it all means. Maybe some of you have already seen it, some explanations in the 4491 manual. The National Tax Training Committee, the NTTC, is adding significant information to the 4491, and we'll be sending out new versions digitally in the coming days and weeks. As a reminder, these items are in addition to the standard or itemized deduction. So in essence, everyone can benefit from these deductions if they are eligible for them. It isn't just for some people. Yes, Ken?
The new 4012 and 4491 was posted yesterday.
Oh, okay, great. Gosh, must have been late yesterday because I double checked it about 6 o'clock last night, and I didn't see any change to the 4491. So that's good to know. Thank you. Yes, Kim.
The vehicle loan interest is for only new cars?
We'll get to it, Kim.
Oh, I'm
Be
sorry.
patient. That's all right. So the whole point, we're going to get into each one of these one at a time. So let's start with the tips deduction. It is a limited time period under the current bill, just 2025 through 2028. And this is for qualified tips up to $25,000. This amount doesn't double if you're filing jointly. The deduction is capped at $25,000 of qualified tips per year per tax return. The tips are supposed to be voluntary, and they apply to both employees and self-employed, although you'll see as we go on in the presentation, the tips deduction for self-employed is definitely more limited than if you're an employee, and we'll get into those rules in just a minute. There is a phase out, and how TaxSlayer will be addressing this and the other deductions will be covered in the TaxSlayer changes section that will be after this initial presentation. As mentioned previously, this is an add-on to standard or itemized deductions. There's a new tax form. It's the Schedule 1A, and there are 5 parts to the form, a part for each of these new deductions. And so part 2 is the tips deduction. If you are self-employed, the tips deduction will reduce the qualified business income for the qualified business income deduction. A social security number, a valid social security number is required for the tip earner. And if you are married filing separate, sorry, no deduction for you. And you will find that consistently through these deductions. So this is what the Part 2 on Schedule 1A looks like. This is a draft. Oh, let me get rid of that first. So this is the no tax on tips form and or portion of the Schedule 1A. We'll get into how the data entry flows in, but basically, and we're going to get into this next, we're going to be taking the information off of tax forms. This isn't where somebody writes a number on the back of a napkin and says, yep, these are my tips. There are some parameters that need to be met in order to come up with what the income is. And where you see on the form, see instructions, it's possible that the instructions have already been communicated since this presentation took place 2 weeks ago. Back in late November, the IRS did issue a bulletin or a notice that got into the details of these new deductions. So when talking about the tips deduction, the tips have to be reported on a tax form. What that means for employees, the tax forms involved would be a W-2, the form 4137, which is the unreported tips, and form 4070, which is tips reported to the employer. Again, I'll get into that in a minute. The key thing off of here is the tips must be reported on a tax form. If you are self-employed, same thing, tips must be reported on either the 1099 NEC, 1099 MISC, or the 1099K. That's going to be a little more difficult for the self-employed just because of the nature of their business. And we'll get into that. The IRS, as far as the W-2s for 2025 for this year, the IRS didn't mandate or didn't make any changes to the W-2 form. And so there's going to be information that's not on the W-2. And so there's no place for the issuer of the tips to identify tips aside from what's already on the W-2. But there are boxes on the W-2 that the taxpayer can use to come up with the amount for the deduction, and I'll get to that. And lastly, in terms of eligibility, it must be a qualified trade, and we'll show what those are shortly. So let's go through some of the forms. So here's your typical W-2. If you've handled taxpayers with tip income before, you're familiar with Box 7, Social Security tips. These are the cash tips that the employee reported to the employer using their form 4070. This allows the employer to withhold Social Security in Box 4, also the Medicare tax in Box 6. So for example, if you had Social Security wages and you also had Social Security tips in Box 7, you would add those two, Box 3 and Box 7, those two amounts to get to what the Social Security tax withheld figure is. Same thing for the Medicare piece. You would take the Medicare wages and tips straight from the W-2 and the Social Security tips amount, add those two to come up with your Medicare tax withholdings. So for servers, what this allows them to do by putting the information in the Social Security tips, it allows the employer to withhold Social Security and Medicare tax on those tips that they gave that information, unreported tips, they gave that information to their employer. And that way they're not stuck at the end of the year having to pay the additional Social Security taxes and Medicare taxes. So these are actual tips reported to the employer that helps then the FICA withholdings. Box 8 over here is what we call allocated tips. And these are tips based on an IRS agreed measuring stick. For example, 8% of gross sales. And so the business says, I'm just going to allocate tips based on 8% of our daily, weekly, monthly sales. I'm going to allocate it to my employees in that manner. Because this isn't a real number, no tax has been withheld. And so this amount is what goes on to one of the other forms we were just talking about, the 4137, the unreported tips. And if you're like me, I've never, in my 3 tax seasons, have never had anyone come in with this information on a W-2. So this is all new to me as well. So this is the 4070 form. This is the employee's report of tips to the employer. In fact, I was having my hair done a couple of weeks ago and somehow got talking about taxes with my stylist, and she was very familiar with this form because she is a W-2 employee, and she does in fact present this form to her employer so that these tips can also be included on the W-2 in that box 7. And so the IRS has said that the total of these reported amounts can be used by the employee to compute their tip deduction. And it would come in out, or the amount we would, I'm sorry, the amount we would take, it would be on box 4. This form is fairly standard. As you can see, it hasn't been revised since 2005. And so most folks who work in the service industries that receive these cash tips are probably very familiar with this form. The Form 4137, unreported tip income. This is where you note your total tips minus any tips you reported to your employer to go to unreported tip income. If you enter unreported tips on the W-2 screen in TaxSlayer, that amount immediately goes to this Form 4137. If you're subject to allocated tips, box 8 on the W-2, that information would also go to this form. Note that allocating tips or keeping a tip log are not reported to the employer, so they will end up in line 4. So the end result is what are the unreported tips, and that's what's in the line 4 bucket. So for a W-2 employee, they've got their W-2, the 4070 employees report of tips to the employer, and the 4137 unreported tips. These are the 3 forms that the employee can use to get at the tips deduction, cash tips deduction. So let's look at the self-employed tip earner. This is a little dicier because, again, they have to, the tip amount needs to be reported on one of these 3 tax forms.
Before you move on, you got
Sure.
a question.
Go ahead, Jeff.
It's important to also note that some of these forms may be automated in point of sale systems at a restaurant, for example. So instead of actually filling out paper forms, they may at the end of their shift go in to their point of sale system and enter their tip information in. But there are reports out of the point of sale system that basically duplicate these forms to give the information back to the taxpayer. The other thing that has made me understand this a little better and may be helpful when explaining it to the taxpayers is no tax on tips is a misnomer. They have already been taxed on the tips that they have reported. And by filing their tax return, we're getting them a refund on the taxes that were withheld from the tips they reported. That means that if they did not report any tips, such as cash tips that they stuck in their pocket, they cannot use that cash amount as a deduction because they never paid taxes on those tips. However, cash tips are still being required to be reported as income. It's just not, they're not eligible for the tip deduction. Thanks.
Thank you, Jeff. Appreciate that. Okay, so for the, somebody was vacuuming outside my house, and now I close the door and I feel an echo chamber. All right, so, okay. So for the self-employed earner, they can use documentation such as receipts, point of sale system reports, Jeff alluded to, daily tip logs, but they have to be included on a tax form for the self-employed. And that becomes I think the biggest challenge we're going to have with that. For example, let's say you have a contract that calls for $1,000 payment, and the person performing the service actually received $1,100, $100 tip, because the customer or the client was so happy with the service. Taxpayer needs to go back through their records to figure out what that tip amount was, but really they have to, whoever's issuing the 1099 has to include that tip in the total amount. So the 1099 needs to say $1,100, and then the taxpayer says, here in my records is the $100 that was over and above the initial contracted amount. And so that is what is my tip, my cash tip on that job. So just a little more homework. Self-reporting initially was allowed for the tip deduction for self-employed. That is no longer the case. And so cash income that's not reported on one of these forms does not count towards the tip deduction. And that's going to be something that, but most of the self-employed people we typically deal with, our typical Tax-Aide clients, are your gig workers, your Uber drivers, and DoorDash, where their employers know that tips are a large portion of the income, and so they have those systems in place where they are capturing the tips. Kind of just anticipated what is showing on the slide, that some of these statements provided by some of these gig companies like Uber, they used to break out the tips already, and so are thinking that it's rather likely the gig companies will be able to break that out as the information is readily available. And for the self-employed individual, they need to confirm that the tip was voluntary and in a qualified trade. So let me go back to my earlier example where I had a contract, and in my contract, I said, hey, if I get the work done ahead of time, you owe me $100 tip, quote unquote. Well, that's not necessarily voluntary. That's part of the contract, and so would not be considered for this deduction. Let me also stop and say that as we go through some of these deductions, tips, and especially overtime, that this isn't, we're not going to audit the taxpayer. It's up to the taxpayer to compute the amount, in this case of voluntary tips. And Jeff, can you turn off your microphone, please? So compute the volume, or compute the amount of the voluntary tips that they received. When we get to overtime, same thing. They've got to do the work. It's not up to us to audit it or to calculate it. We're going to be we'll have worksheets available to help with this. But again, the burden is not falling on us. Finally, in terms of self-employed, the tips deduction is limited to the net profit from the business. Now, there's been some discussion, and I don't have it here in terms of what net profit, what they exactly mean by net profit and how that's going to impact things. And so stay tuned for that. The tip deduction cannot exceed profits from the business. And also recognize that this is not a schedule, the tip deduction piece is not a Schedule C expense. It's going to show up on the Schedule 1A. Schedule C is not going to be affected by the tip deduction. Initially, as Jeff pointed out, the IRS thought this was going to be a no tax on tips thing. Not quite the case. It's similar, but not really. Question being, will TaxSlayer be able to recognize these limits? Will they make the appropriate adjustments? We don't know yet, but one thing I will share with you is an update that came last week on a webinar, and I'm just going to sort of read some information for you, and this has to do with the qualified business income. That when the IRS posted draft instructions, there were still some questions, or there were answers, but also new questions were asked. The tax layer currently has not changed the qualified business income, the Form 8995 calculations. It's still using last year's tax rules. So it's a work in progress. There are 3 rules having to do with tips deductions, which have yet to be implemented. First one, the tips deduction is limited to the business net profit. Again, we're not sure what the definition of net profit is, or they may have finalized it recently, but still there are some questions. And that's why this is not going to be automatic in terms of how it's figured in tax layer. The limit must be applied separately for each business. So if somebody has multiple Schedule Cs, you have to look at the limits separately. Since tax layer only allows you to enter total tips, it's not separate for each business. So tax layer currently cannot do it automatically. And they would have to allow entering the tips on Schedule C in order to do this limitation. And we just don't know what's going on. Right now, we may have to do these adjustments manually and just stay tuned. Secondly, the qualified business income must be reduced by the tips deduction. This too is not automatic. It's not automatically done by tax layer, and you may have to do it separately for each business. And so that's the second issue that we're up against. And the third one being that QBI is limited to taxable income. Right now, still waiting on what the true definition is and what might be the workaround. So that's just sort of a FYI, stay tuned. Hopefully you don't run into this too much. Let's move on to eligible trades for the tips deduction. These are the main categories that are eligible. Don't expect you to memorize these codes. They're going to be on the back of the tip worksheet that I'll show you shortly. And so these are the primary codes. The IRS has drilled deeper in their regulations to go from, a category to a specific occupation, to a specific job description, so on and so forth. And so that's all in the details. We're just going to stay at that higher level for now. So this is one of the many worksheets that the NTTC is creating for us. It's a work in progress. And this worksheet is to be completed by the taxpayer, not by you. Are you an employee? Not an employee? Is this a qualified trade? On the back, here are the categories that they're going to make sure that they are, the job that they are applying the tips deduction to is a qualified job. And the taxpayer should be able to classify themselves. Now, $64,000 question. What's an SSTB? Sounds like something I may need to go to the doctor for, or that's maybe something different. Anyhow, this is specified service trades or businesses, and the law specifies that these SSTBs aren't eligible for the tips deduction. However, the IRS has decided that that is not, in fact, the case for 2025. And so something we'll have to deal with next year. So in recapping, the tips deduction must be a qualified trade. You must have a valid Social Security number. You cannot file for the deduction if you are filing married filing separate. Tips must be voluntary. For the employee, if it's on their W-2, their Form 4137, their Form 4070, they can run with it. Those numbers are easily accessible. For the self-employed, they have to confirm whether the tip was voluntary or not. And tips must be in cash, non-cash, basketball tickets, case of wine, non-cash tips do not qualify. So, any questions on the tips deduction? Either raise your hand. Is there anything in the chat box? I don't see it. Everybody still there? Excellent. Let's move on. Overtime deduction. Thanks, Rick. You're my new best friend. So overtime deductions also for 2025 through 2028. And if you think tips are confusing, overtime may be a little worse. Let's hope not. So for 2025, there's no actual reporting that's required by an employer. So we really don't have any idea what we're going to see in terms of documentation. Some employers will have this information readily available. Other employers won't. So let's run through what the federal rules are, how Tax-Aide is going to deal with it. It's still a work in progress. We'll have more concrete information pretty much by January training time. So the overtime deduction is up to $12,500, $25,000 if married filing joint. Now, if you're filing jointly, it doesn't have to be $25,000 for the taxpayer, $25,000 for the spouse. One person can claim the full $12,500 for the taxpayer, $12,500 for the spouse. If filing jointly, one person can claim the full $25,000 for the overtime. Same as tips deduction, there is a MAGI phase out. And just like tips, this is an add-on to the standard or itemized deductions. Social Security number is required for the overtime earner. And no deduction if you're married filing separate. You know, we get folks that come in and they've got they're set, and maybe this will change a few people that they're leaving so much money on the table. This is part 3 on Schedule 1A, no tax on overtime. This is a draft. Just gives you an idea of what's involved, qualified overtime compensation on W-2, and so on. So what's qualified overtime? Congress is using the Federal Labor Standards Act definition. The basic rule is working more than 40 hours in a week. There are, however, variations. For example, firefighters might work 40 days, then be off for 4 days. For them, overtime is based on a 14-day period. Or let's say you work 4 10-hour days in a week, or you have some employers who offer employees the option of paid comp time off instead of taking cash. Comp time off also qualifies as overtime. State laws, because the FSLA overtime rate is 50%, the IRS is using that as the maximum overtime rate you can take for the deduction. So if someone was paid double time for working on Sundays or holidays, they can only take up to 50% of the regular pay for this deduction. And state laws and employers may be more generous. Depending on the state, this may be easier to administer or more difficult. It's important to note, I already said this previously, it's not our job to figure out the overtime. It's up to the taxpayer to figure it out. You can kind of help them with the math, but they've got to provide all of the documentation. They may need to go back to their employer for more information. They may have to pull out their last pay stub for the year and look at the total overtime. You know, the W-2, as we already established, doesn't break out overtime. But I know when I was working, I would look at my pay stub and overtime was broken out. And so I think that's where a lot of folks are going to get the information, and either they can get it online through their pay system or they'll have to go back to their employer. Next year, employers are going to have to do a better job of reporting this. But for this year, the IRS was like, we're not going to change any of the forms. It's too late. And so overtime is included in that total wages amount. Wait a minute. Sorry, I kind of lost my place. However, the employee is going to get to that overtime amount, they're going to have to figure it out with a little help from us in terms of a couple of mathematical formulas. Okay, so the overtime pay must be included in the W-2. So I just said earlier, there is no separate box for reporting overtime on the current W-2. The draft for next year does have that box in there. It's kind of unusual, but possible that's for somebody to be covered by the Federal Labor Standards Act and not be treated as an employee, in which case their pay would be reported on a 1099 NEC or MISC. It's doubtful we're going to come across the situation, but if we do, technically it is eligible for the overtime deduction. As we stated, overtime pay would be shown on the employer statements or pay stub. And, you know, some employers are going to want to readily provide this information to their employees this year. It's something new. It helps their employers. And so the more the employer can help the employee get to this information and take advantage of this benefit, they're going to be viewed very positively. So they could even come up with a report that says, this is the overtime hours you worked. We paid you at the overtime rate of X, and then the taxpayer can do the arithmetic. Just as a reminder, if the overtime premium is more than 50%, the deduction is limited to 50%. This is the worksheet that the NTTC is working on for preparing the overtime. Just as an aside, I've already shown you, I think, 2 worksheets, and these are worksheets that you may want to have available at your site and to give out when people come to pick up their intake packets or when they check in for their appointment. And let's say you have a client facilitator and the client facilitator asks you, did you earn overtime this year? Did you have tips? And if they answer yes, the client facilitator gives them one of these worksheets. And so while they're waiting before their employment or their appointment, they can try and fill out this sheet. I think what our biggest challenge this year is going to be these folks coming to the appointment unprepared. And we'll talk in a minute of what do we do in that situation. And that's going to be the most efficient and effective for us. So the worksheet will include an area where you can calculate the overtime. There are different formulas, divide by this, multiply by that. And it will be beneficial when you have the final pay stub that shows the total overtime. If all the overtime is at the same rate, say 150%, there will be a calculation you can do to get to the deduction amount. And remember, the deduction is just for the 50% portion of the overtime. You know, you earn time and a half, but the deduction is only for that half portion. And the worksheet will state that the taxpayer is responsible for retaining documentation to support the deduction. If the employee has no idea how to figure this, what are we going to do? Well, we're not going to turn away the employee and say, sorry, you're out of scope, you're out of luck, because that's not in our nature. You know, we want to help people as much as possible. So what we can say to them is, I can prepare your return without the deduction. Then after you pull together all the necessary information, we can file an amended return and claim the deduction. I'll admit that's not the ideal case, but it's better than turning them away. Here's another option you may want to consider. Okay, John, I'm going to prepare the return today without the deduction, but I'm not going to file it yet. This will give you time to pull together the necessary documentation, come back in, and we'll plug in the overtime deduction or the tips deduction. I see this as a better option than saying we're going to file the return and then you come back and amend it. But I'm sure there are many of you out there that have a different opinion than me. And it's really entirely up to local coordinators and how you're going to want to handle this. Ken, I don't know if you have any thoughts at the state level, or if Teresa or Julie or Juanita have any thoughts. Yeah, Steve.
I agree with you. We don't want to generate amended returns down the road. So just put the return on hold and have them come back in a week or 2 or 3 and then finish the return. But yeah, we don't want to work and then generate knowing that we're going to have to amend the return down the road. So let's just hold it and then we'll let them get back to us. We've done that before when people come in and they forgot their Social Security statement or they're missing a document. We just hold on to it. We give everything back to them and tell them to come back in a couple of weeks, and then we finish their return.
Yeah, great. Thank you, Steve. Beth?
Yeah, Karen, you kind of already touched on what I was thinking. My guess is that the intake form does not refer to overtime or tips. That's my guess. And so it becomes really important then for the client facilitators or whoever is the first person in the door looking at, taxpayers to remember to ask these kinds of questions, right?
Mm-hmm. Yep. And, Beth, and thanks for bringing up that point, because I may have it somewhere else in my notes, but since you raised it, one of the things that I've been rethinking as an LC is I have this appointment checklist that is given with the intake form and the intake envelope for folks to pick up, hopefully before their appointment. Mm-hmm. And my thought is I'm going to adjust that appointment checklist, get rid of the more common stuff we ask them to bring, and really use the checklist to address these new items.
Yeah, that's what I was just
because it's so critical for them to bring the documentation.
Yep.
Great. Thank you, Beth.
Thanks.
Mm-hmm. Any other questions about overtime?
You got one that's in the chat that says, what is the overtime deduction percentage?
It's not a percentage, it's dollars.
Well, technically it is a percentage. It's 50% of your base pay. So if you're getting paid time and a half, that's 150%. So you would take the total amount and divide it by 3 to get your 50%. If it's double time, you divide it by 4. My calculation would be how many overtime hours did you work? What's your base pay? And I would say, okay, you had 20 hours of overtime and your base pay was $10. It's $200. And so you multiply your base pay, or subtract your base pay cut in half times the number of hours you worked overtime. But the IRS is saying we're only paying the 50% part. So it's time and a half is 150% of your base pay.
Mm-hmm. Yeah. And then, but it's then up to a maximum of $12,500. So I guess there's a percentage part as well as a dollar part in it. And if it's not broken out on the W-2, how do you know how much of the total is overtime? That's the question, Roberta, where the employee will have to go back to their employer or look at their pay stub. Usually a pay stub shows the breakout of overtime. Usually maybe too loose of a word, but the pay stub maybe, or they would have to go back to their employer. The employer is going to know. And so it's not going to be on the W-2. Don Oland, you have a question?
Yeah, since clients with tips and overtime are a small set of our customers, can we presume that our LC or a designated counselor will be available for consult on any question about preparing these returns?
I would answer that, Don, to say, I'm sure that there's someone who's, interested in tax law enough that they're going to say, hey, I'm going to really study up on that. I like the idea of maybe, I don't know, from an LC standpoint of perhaps saying, hey, Don, I would like for you to be our resident in-house expert on these new deductions. Are you willing to do it? Or that becomes the LC. But I see the point that you're making, and I like the idea a lot. Certainly, we all should have some cursory view of it, or be able to ask the right questions, and then do as much as we can, and then we get stuck, and then we go to whoever's got more experience in that. It's kind of like any other situation we run into that, and we all run into it, that you're not used to doing a less common scenario. I'll throw out my favorite Medicaid waiver if Julie Dugan is listening, and I won't know that, and I'll go to somebody else who hopefully does at my site. But it's a valid point that you raised. Any other questions on overtime? Okay. Now it's all downhill from here. Get into the easy stuff. So our next deduction is the interest on the passenger vehicle deduction, also good for the next 4 years. And this is qualified interest up to $10,000. There is I don't even know how to, the modified adjusted gross income phase out. As a reminder, this is an add-on to standard itemized deductions, and it is Schedule 1A. This will be Part 4, and I'll show you that in. Right, we are back, everybody. Welcome back. Thanks for coming back. Let's see. Okay. Let me just read a question on to Jeff. Please. Did you mention that cash tips received and reported would have been taxed previously, and that the cash tip adjustment is actually a deduction below the line? So are cash tips already included in the W-2 of the employee? Yeah, I think what Jeff was alluding to, cash tips are reported on the W-2 if the employer is tracking the cash tips, or if the employee fills out that form 4170 of tips reported, and the employer includes it in the W-2. And so I think what Jeff was alluding to was the fact that you've got a lot of people who have in the past have not reported cash tips that they had not reported, because then they were subject to paying tax on that income. Now that they've got a deduction that's in play, you may see more of that. And Jeff, if you have more to add or want to clarify, please do.
Yeah, going back to the W-2 example that you gave, if you add box 7 and box 3 together, that will give you the total in box 1. So that shows you that box 1, which is total wages, includes salary plus tips. And box 7 actually breaks that dollar amount out for us to be able to use for the deduction. We will only be the IRS will only allow a deduction on tips if taxes have been withheld from those tips, not for cash tips that they may have put in their pocket and decide later on, or even kept on a tip log that they didn't report to anyone, so therefore no taxes were ever withheld. But it's important to remember, all tips, whether reported or not, are classified as income. And if they come forward and say, oh, well, I want to include my cash tips of $500 that I never told my employer about, to create an accurate return, we need to report that $500 as additional income. It just does not qualify towards the tip deduction.
But I would disagree, Jeff, because as soon as
I
you
do
report
too.
that $500 tip, it's going to show up in the above the line calculation to be taxed. And therefore, it should be able to be backed out and the below the line.
But the tax that we're talking about is tax withholding that the employer did against those tips, not the fact that they're going to be taxed as income on their tax return.
It doesn't matter. It's the tips are still going to be taxed because you report them as income. They're going to be taxable income. So therefore, they should still be eligible for the below the line deduction. And unless
Because of that form
it
when reported
says
tips.
you can't do that, I mean, you may have read it somewhere and I haven't seen it yet, but I saw nowhere anything that said that it was tips that were taxed.
Well,
Correct,
that's why.
because that form, the unreported tips form.
That's where those tips would be reported then, Karen, is on the unreported tips form.
Correct.
Okay.
And
Sorry-
that's where
sorry
the
for the
employee,
confusion.
yeah.
It's not that we're not reporting the tips. If they report the tips, if they tell us they got tips they want to deduct, we have to say, well, first thing you got to do is report them as income. So once we do that, it becomes an above the line addition. It's going to be taxed. Whether or not you paid the tax ahead of time or haven't paid the tax at all. The other thing that's going to happen is it's going to populate the form that they're going to take Social Security, Medicare tax out of it.
Mm-hmm.
So they are going to pay tax for Social Security and Medicare on those tips they didn't report previously.
Mm-hmm.
They're not going to get a break on that.
Yeah.
Okay, thanks
Jackie,
for the
did you have a
clarification, Ken.
question? Yeah.
No, thanks.
Okay. So moving on to interest on passenger vehicle deduction. Already went through this. So qualified interest up to $10,000. It's an add-on, just like everything else we've been talking about. And so what is eligible? It has to be a passenger vehicle, such as a car, minivan, SUV, etc. Commercial vehicle could qualify if it's used personally. Vehicle must have 2 wheels or more, gross vehicle weight less than 14,000 pounds, vehicle intended for use on the road. Final assembly in the US, that's going to be an important one. And the vehicle has to have been purchased after December 31st, 2024. And it is collateral for the car loan, meaning the lender has a lien on the car. This is what the Part 4 of Schedule 1A looks like. This is the no tax on car loan interest. And what the taxpayer is going to have to provide to us is that vehicle identification number. We will then, if the taxpayer has documentation to prove final assembly was in the US, great. Otherwise, we will have the VIN locator, the link that will, you enter the VIN and it tells you whether it was final assembly in the US. That link is in our useful tax prep links sheet. And that's how we will determine whether this is a qualified vehicle. As far as this total interest here, if the vehicle is partly used for business, you can take the business part of the interest on your Schedule C, and the balance of the interest can be claimed as this below the line deduction on Schedule 1A. When we get into the tax layer demo, this is included in the demonstration. Our friends at the NTTC have created yet another worksheet for us to use, or for our taxpayers to use. It walks them through all the requirements. If all the answers are yes, then they get the deduction. If any answers are no, no deduction. And I just mentioned the useful tax prep links. That's one of you've got your tax resource sheet, and then the useful tax prep links sheet. One of the two most important tools that we have to find whatever it is we need to prepare a tax return. So the useful tax prep links has that link to look up the VIN. Somebody brought up in the webinar that VIN numbers beginning with 1, 4, or 5 are assembled, or I have the word usually in my notes, but that could be wrong. But 1, 4, or 5 VIN number beginning with those digits indicate they were assembled in the US, but we still want to use the VIN locator. Now, unlike tips and overtime deductions, a Social Security number is not required to be eligible for this deduction. An ITIN is sufficient. The deduction is unlimited as to the number of vehicles, so you can have more than one, just up to $10,000. And while unlikely to happen in the first year, if the loan gets refinanced, the qualified loan is going to stay qualified even after refinancing. And for 2025, lenders can mail or otherwise make available to the borrower the amount of interest paid. If the taxpayer has an online account, they should be able to go in and either see on their December statement, year-to-date interest, or many times the January billing will say this is the interest you paid last year. So hopefully lenders, make all that information available. So what's not qualified for the QBLI deduction? Any kind of used vehicle, not qualified. Fleet, commercial vehicles, except if used personally, or leased vehicles, not qualified. Leased vehicles don't qualify because there has to be a purchase and the loan has to be secured by the car. If the vehicle is bought for scrap or parts, doesn't qualify. If interest was paid to a related person, not a financial institution, does not qualify. Details of this can be found in the 4491. This is a draft of what the new 1098 VLI, vehicle loan interest statement, might look like. Looks, rather similar to, say, a mortgage interest statement. But you see, so vehicle loan interest received by the lender. Here's the information of year, make, model, VIN number, and so on. It's possible that some lenders have already adapted their systems, and this document may be sent out for 2025. And you may see it, or then again, you may not. And that's all I've got to say about the vehicle loan interest deduction. See, it's all downhill from here. Let's move on to the enhanced senior deduction. This is a good one. It's only for 4 years, though, right now. And it is $6,000 for taxpayers 65 or older. There is a MAGI phase out. Social Security number is required. Another reason why you really want to rethink married filing separately as your filing status. And this information shows up on Schedule 1A, Part 5. Now, it's interesting. There was a lot of talk when this was floated. Is there a phase-out amount on the qualified? Is there a phase-out amount on the qualified car loan amount? Yes, there is. I just didn't put what the amount was. And so, but also the, I didn't put the amount. I don't know it off the top of my head. I have a sneaking suspicion that all of these major phase outs, except for this one, are certainly at a higher income level than what we're used to, the clients we typically assist. But one of the things I wanted to mention about the senior deduction is when the bill was being introduced, people were thinking that, oh, this is part of my Social Security. It's going to reduce my Social Security taxable amount. And this deduction has absolutely nothing to do with Social Security. It's completely unrelated. Taxpayers don't have to be collecting Social Security. All you have to be is 65 or older to be eligible for this $6,000. And it's $6,000 per person. So taxpayer and spouse are both $6,000 or are both 65 or older. It's $6,000 per person. And fortunately, this one is automatic. If you've been working in Practice Lab, doing some of the exercises, you'll see that this $6,000 is already in there, and TaxSlayer takes care of it automatically. So those are all of our deductions. Tips deduction on tips, deduction on overtime, the new vehicle loan interest deduction, and the enhanced senior deduction. And just have a couple more things I want to talk about, just tax laws, what is being terminated, the new clean vehicle credit and the used clean vehicle credit expired or ended on September 30th of this year. And the energy efficient home improvements credits expire at the very end of this year. Unfortunately, the credit was supposed to go to 2032. It is now expiring at the end of this year. While we're talking about the energy efficient home improvement credits, there's some new additional reporting requirements in order to qualify. And that is the taxpayer needs to provide the first 4 digits of the qualified manufacturer identification number. That would be right here, and on whatever the purchase was. This may be something that holds up the preparation of the return, similar to what we've already discussed. I don't know if this is information that you can look up online based on a manufacturer. I would imagine any of this will be addressed in the 4012 or the 44 mention of it, so you're not surprised. Got some credits or adjustments that were previously expiring but were now made permanent after 2025. The qualified business income deduction stays. The home mortgage interest, the cap on qualified home mortgage, $750,000 of debt now stays permanent. The extra $100,000 home equity loan is gone forever. Remember when private mortgage insurance used to qualify, then it went away for a couple of years, including 2025. Hint, hint, that's, I believe, a question on one of these certification tests. Well, it's back starting next year, not this year. Casualty loss rules are remaining, and some miscellaneous itemized deductions are gone. However, there are just some new changes to talk about coming in 2026. Nothing we need to think about for 2025. And somebody, if you have your microphone open, you could please mute your microphone. Appreciate it.
Oh, yeah.
Rebecca, mute your mic.
Rebecca, please mute your microphone. Rebecca H. Thank you. Okay, so again, new for 2026. Don't commit it to memory, just kind of an FYI to put in the back of your mind. Itemized deductions may be scaled down, gambling losses not fully deductible, so on down the list. Yes, Jackie. Unmute your microphone if you have a question, Jackie Rosen.
My bad.
Okay,
Sorry.
no worries.
I'm sorry. I just went back when you're looking at the 5695 and talk about the energy efficient home improvements, and you've got the doors and the windows thing. What about the credits on the HVAC? What's happening there? Do we need to get all the
That 4-digit.
Go ahead.
Are you talking about the 4-digit code that was just introduced for, whoops, wrong way. I don't know. Can somebody answer that for me?
You know, the HVACs, we went through that whole thing with whether it's a heat exchange thing or a not, or can you do the air conditioner separate from the base unit and all those things? Are those going away as well?
Help, somebody.
Rick or Ken, we went through that a lot. I know we did that at Millsboro a couple of times. There you go. JC raises hand.
Go ahead, Jeff.
Yeah, Karen, in the original deck, there was a whole description about the HVAC, and there was even the description of doing an additional electrical work that was needed to support the HVAC, and how that additional electrical work could be written off as well. Do you remember that discussion as part of the original presentation?
Honestly, I cannot say that I do. And
Yeah,
it's
Jack-
I took some slides out and for time purposes. And so,
Yeah,
yeah.
I think that was part of that. Yeah, Jackie, it doesn't require the same level of documentation that these two do, where you need that QMIN code, but there is a list of products that are deemed to qualify for this, and I'll look up where that list is that you would have to go up and search to determine if it is a qualified HVAC type system that can be written off.
Okay, thank you.
Yeah, and I'll find that slide and I'll put it back into the slides that I post. If some of you were out on break, didn't hear me say this, that all of these slides from this presentation today will, and as well as the recording of this program, if God forbid you want to listen to it again, I'll put that probably on the Delaware microsite. And so that way everybody can access it, but I'll let you all know when and where you can find everything. So, and gosh, we're not even done. Is any other questions as far as these tax law changes and the deductions?
Stuart has a hand raised.
Thank you. Go ahead, Stuart.
Yeah, there's a page on the IRS site, Karen, that last edited just this past Monday. So I suspect it's a work in progress, but it's entitled Energy Efficient Home Improvement Credit Qualified Manufacturers. And it lists the name of the manufacturers, people like Pella and Anderson, but it doesn't give the 4-digit number we're looking for. But I suspect that's going to become available somewhere on the internet.
Yeah, probably so. And thanks for sharing that. Roberta, your question is, there a summary of all the bad parts of married filing separate? Get a lot of them normally. It would be good to warn them prior to starting the return. I don't know if there's a summary anywhere that exists, but I do know that, and I'm sure you all have clients who you've dealt with them regularly and you know not to even broach the subject. They want to file that way for good reason, and don't press them. They don't care how much money they're leaving on the table, and you just say, okay, just wanted to make you aware. But as far as a summary, there may be some place that gets into the disadvantages of married filing separate, and certainly adding these new deductions just promotes the case for changing to married filing.
There is a limited list in the 4012 on page B18.
Ken, you are the best. Yeah, Beth Wagner.
On a employer's pay stub with relation to overtime. And so if there's overtime money there, is that the additional, say it's the 50, they get paid time and a half. Is that just the half time? Or would it be the full amount of hours of overtime and we would have to back out what the 50% is?
Yes, exactly. That generally speaking, it's whatever they pay. So from the employer's standpoint, overtime is that for them, the time and a half. And so that is considered from the employer's point of view, the overtime. For this deduction, all that is eligible is that, base time plus the overtime, and we just want the plus overtime. So yeah, that's the math that Ken was alluding to earlier, that the taxpayer with our assistance will have to do the math, but the employer isn't necessarily going to break out, here's your overtime pay, of which this was the base rate and this is the separate overtime rate. So it's one number.
Right. Okay. Thank you. That was very helpful.
You're welcome. John Mercante? Unmute your microphone, John.
Yeah, I think I did. Can you hear me?
Okay. Yes, I can.
Married filing separately versus married filing jointly. Believe it or not, this is if you have one of these AI engines, it kind of gives you a nice summary of that. Okay, you just type in, advantages of disadvantage of married filing separately versus married filing jointly. It comes up with a whole list of stuff. So anyway,
Does it list the new deductions?
I don't know. I didn't. I just.
Oh, I thought you'd done it while we were talking. Okay.
Yeah,
Great.
yeah.
Thank you, John.
Yeah, that's modern technology. What can I say?
Yes, but don't always believe what AI is pointing out.
Are you kidding?
I was going to say it does not list
Oh my
these new
God.
deductions.
Okay, all right, good.
So maybe it'll be updated later, though.
Yeah, could be.
Thanks, Ingrid. Any other questions? Okay, point of meeting is that right now, what I was going to do, or how we were going to handle the tax layer changes, was rather than me redoing something that was already done very well, there is I was just going to present the webcast that was done, and what it is the guy from NTTC is preparing a return for Georgia Martha Washington that covers everything, all of the different deductions and such. The thing is, the video is approximately an hour long, and we only have 25 minutes left. And so my thought is to say that I will post the link to this video as well as the tax return, the final tax return, that so you can see and hear everything, and you watch it at your leisure. And I guess I'm deferring to Ken or a show of thumbs up, if that would be a better way to approach it, just so long as, all right, everybody, I want 2 thumbs up that you promise, you solemnly swear that you will watch this video, because it is quite good. Okay, anybody object and they want to stay and want me to run this video? Please, God, no. Okay. So with that, Ken, do you want to add anything?
Where do we find, how do we get access to this video?
I will send you the link. You will either receive directly from me if you are located in Newcastle County or Kent County. I will send you the link directly. For Sussex County, the link will be sent to Jeff and Teresa to send out. I will also post everything on the Delaware microsite. So you have 2 places, either email or it's going to be on the Delaware One Tax-Aide microsite that hopefully you all know how to access. And if you don't, I will type the link in the chat. Look at this. I can type, talk, and think at the same time. So it's Delaware Tax-Aide, AARPFoundation.org. You would go to volunteer login, and the password is counselor help, all one word, capital C, capital H. All right, last call for questions, comments. Yes, Stuart.
Yeah, Karen, I agree with you that some people come in, married couples, and what's hers is hers and his is his, and you could show them that they're costing themselves $5,000. They don't want to hear it. But I just want everybody to know that there is a tool in TaxSlayer now that if you prepare the return jointly, if you go to miscellaneous forms,
Yep.
you can do a married filing joint versus married filing separate comparison just by
Yes.
clicking a button.
Mhm.
And that's a good way to check which way is more advantageous to them.
I've used that before, Stuart. It changes a few of their minds.
Yeah, one would hope.
Yeah, thanks for reminding me of that. Karen Munger, yes, this is the link, and I just put the actual hyperlink to the Delaware Tax-Aide microsite. That is an internal site. Let me see if, bear with me just a second. There we go. Look familiar, people? Welcome to Tax-Aide Delaware. This, and then you would go to the volunteer login and type in counselor help. Karen, we will continue with that. Oh, sorry. Okay, last call. Any other questions?